Courtesy of Mr. Market, Lowe's is currently trading at a valuation that's extremely attractive and more attractive than it has been in more than a decade. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer tool. And today I'm going to bring you a video where I'm going to talk about investing in dividend growth stocks. And one of the things I want to do is I want to point out some of the nuances of dividend growth stocks. So I'm going to cover three companies here. I'm going to refer to them as research candidates. These are all companies I'm personally currently researching. I think they're all worthy of research, but I do think they all have different characteristics that apply to different investor objectives. And that's something that I want to talk about just briefly. A lot of investors think that only total return is what matters. A lot of investors also think only beating the market is what matters. Well, there are times when I would like to beat the market, but there's also times when I wouldn't want to beat the market. And furthermore, there are different ways to beat the market. And as a dividend growth investor, one of the best ways to beat the market is to try to invest in dividend growth stocks, high quality dividend growth stocks that provide you a greater level of income than you could get from just investing in the market, so you don't have to sell shares to supplement your income. In other words, you want to try to find companies that can pay you enough dividends and grow those dividends over time, because you deserve a raise in pay every year, just like you did when you were working. And one way to do that is to invest in dividend growth stocks. So let's go ahead and get into the three stocks I'm going to show you. The first one I'm going to show you is obviously Lowe's Corporation. Now, one of the things I want to do, by the way, I want to also introduce the fact that I'm using the soon-to-be-launched new version of FastGraphs. There's many advantages to this new version I think you'll enjoy when we finally get it launched, hopefully in 4 to 6 weeks. And that is, number one, is there's less scrolling with this new version. You get most of the graph on one side. We accomplished that by putting the navigation on the left side of the graph here. So, it takes just a little bit of getting used to, but I've been playing with it now for a couple of days, and it's actually quite easy. So there are some advantages to this new site, and it also works much better on things like iPads and even cell phones. Although we still don't have a mobile app, this will be as close as we can get to one. Anyway, I do want to now move into talking about Lowe's. Now, what do I like about Lowe's? One of the things I like is I like companies that give me consistent and reliable and repeatable growth. Now, the orange line on this graph represents a PE ratio of 15.09. So anywhere that stock price would touch this line, that's trading at a PE of 15, and that would be, I would consider that fair value for a company that's growing at 15%. Okay, now I do want to show you something. I'm going to shorten the time so that I go past the Great Recession here. And just since past the Great Recession, Lowe's has actually increased their earnings growth to over 19%. So now the tool is switching to the P equals growth rate formula, and the orange line equals 19 times earnings. I want to remind everybody this is an analytical tool, but since the Great Recession, which, by the way, had minimal impact, really. Now, there were, some big numbers. It was minus 7% growth in fiscal 08, which ends in January, minus 20%, minus 19, and then it began to recover. Okay, so the company stayed profitable, but I also want you to notice they continued to raise their dividend through the Great Recession, as I call it. That's extremely important. So I really love the consistency, and I love the reliability here. Now, the light green shaded area is these dividends, which this depicts the dividend payout ratio on these graphs. You can see what percentage of earnings they're paying you as a shareholder. We stack that on top of the orange line to illustrate the two components of return. You get growth, capital appreciation, which is a stock price moving from point A to point B, plus you get the dividend income, if any, that the company pays. Now, what I'm going to do is I'm going to put price on the graph now, and you can see that the stock price clearly follows earnings, but it does get disconnected at times. And so there is what I would call the fair value or intrinsic value of the company, represented by the orange line, but then there's the normal market value that I think is also relative to evaluate as you're analyzing these stocks. Now, over this last 20-year period-ish here, the normal multiple of this company has been about 19.6. Growth rate's been, as I mentioned, 15%. So you can see anywhere you're touching this blue line, the stock price is trading at a PE of 19. And when it's above that, it's higher. Now you can see, because this company has grown at a very attractive rate, that you almost can't overpay for this stock in the long run, but you can overpay for it in the short run. There are times when you could overpay for the stock And, like, for example, here's a period right here from April 3rd of 2015 to September of 2017 where Lowe's would have only generated a 3.5% total return, and that includes dividends. And that was because the stock was expensive. But I also want you to notice this very important factor here, and that is that other than COVID and the Great Recession, it's been very rare that we've had a chance to see this stock trading down here at the orange line, especially in the last 7 or 8 years where we've had this, massively running bull market. Now, another valuation reference that I think is important, the company currently offers a 2.16% dividend yield, and it also offers an earnings yield of 6.45%, which is right on the cusp of what I like to see. But this is an extremely high quality company, as you can see. It's a very consistent company. And, the bottom line is that I like that. I like companies that give me that consistency. I like companies that give me that continuous dividend growth rate. Now, over this long period of time here, if I quickly go into the performance tab, you can see that the dividend has grown by over 25% a year on average, and the compound average 24.29. You can also see that the company dramatically outperformed the market over this time, generating 11.59% versus the SPY at 8.2%, and that includes dividends. But dividends were also, as I mentioned earlier, the other way that this company outperformed the market. Threw off $8,000 on a $10,000 investment over this time versus a little bit over $5,400 by the S&P 500. So this is that consistent dividend growth, and that's such an important factor when you're looking at these dividend growth stocks. You want to see them, regardless how cyclical the earnings is, regardless of how volatile the stock price is, you want to see that dividend continuing to grow. But with a 2.16% dividend yield, if I put the dividend yield up here, the highest dividend yields this has had over the last 20 years has been 1.98%. All right, that's another indication that our value now, where the dividend yield is 2.16% today, would be on the high side. It would be obviously above any of the points that we see in this past time. So, I believe Mr. Market has given us a rare opportunity to invest in this company. Now, from a standpoint of forecasting, looking going forward, analysts are expecting this company to continue to grow at about 11% or double-digit rates going forward. If I use their normal multiple of 19, that gives me a strong margin of safety and an opportunity to make, 20%-ish rates of return. But if I just be more conservative and base it on trading at a 15 multiple, which I want to remind you it rarely has, I still have an 11% rate of return. So I think the risk-reward ratio here for Lowe's is very, very attractive. And it's one reason I'm showcasing it now. I've been looking to get in this stock for years, and I really haven't, because I've always felt that the market was overvaluing this stock, although in a way, I've been wrong about that, because it has been trading very close to its 19 times earnings, between 19 and 20 times earnings. You can see it's below that now. But importantly, the forecast growth rate is for it to slow down. So now I've got to base that on more, historical precedents. Now, other things I like to look at, and I'm going to go through these very quickly now with all three of these companies. I like to look at all the other metrics. So I'm going to go ahead and look at GAAP earnings. I can look at basic and diluted. And, there's some accounting convention where there's some write-offs and stuff. I do like the fact that the company actually benefited during the COVID pandemic. Again, they had some, modest decreases in earnings during the Great Recession, but generally the company stayed profitable and stayed very consistent. So looking at it from the three earnings points of view, the company looks very good to me. Now, cash flow is critically important when I'm evaluating dividend stocks. Now, the cash flow correlation is also pretty strong here. This normally trades at 12.6 times cash flow, but I'm not really interested in the price and cash flow relationship, or I shouldn't say I'm not interested, but I'm less interested in the fact that my cash flows are higher than the dividends and covering the dividends every year. And then even more importantly, I'm going to move on to free cash flow, and I get the same response. Other than 1 year during the Great Recession, the free cash flow has been, generally above the dividend or covering the dividend. Now, a couple of times it got close to just barely covering the dividend, but most years it really covered it. I'll use the word lavishly if you'll give me that. I can also look at it from another cash flow perspective, which is EBITDA, earnings before interest, taxes, depreciation and amortization, once again, I get, very great dividend coverage, and I get a pretty good valuation reference here also. I can look at this and say, this is the normal price to EBIT has been about 9. The current one is 10.9. So it's maybe a tad higher than historical norms, but it's within range. It's certainly not overvalued at this level based on EBITDA. The only one, and I can look at EBIT. EBIT gives me the very similar picture, actually even better, because it looks like it's way below the normal price to EBIT, earnings before interest and taxes. And then finally, I'll go through and look at it from sales. This is the one metric where it falls down a little bit. It looks a little overvalued based on sales. However, if I shorten the time frame again like I did before, sales growth has been a little bit better going forward, and it gets closer and closer to being fairly valued, as you can see. Now, remember, this is an analytical tool, and you don't just look at one time frame and make a decision. You analyze it by going through all the different time frames. That's what you should always do. And again, you also want to go through forecasting when you're analyzing these stocks, and you want to look for those, opportunities to invest in a company that gives you a margin of safety and also provides a margin of return for you. When I'm looking at this, I'm also looking at things like the analyst scorecard, and they have a very good analyst scorecard. The only real misses they've had were during COVID and just coming out of the Great Recession. Otherwise, they've either met or exceeded analyst estimates almost every year. So I really like their scorecard. It tells me the company guides well. It's very predictable. The analysts have a reasonably good history of estimating the earnings. So I have a little bit comfort there. Now from here, I would go into other research. For example, I subscribe to Morningstar, and I will click on Morningstar. Morningstar gives Lowe's a 3-star rating right now. But I do want to make a point. They give the 5-star price at 146, and the close is around 194. So, but they also say fair value is 209. Now that's basing it on what I referred to earlier. Now, I'm going to go through here, and I would go through here and I would read everything that Morningstar offered. I could also go to other sites, for example, Seeking Alpha, which is crowdsourced research, and I can look at different articles and go through different articles. So it's a process, but I can do that very effectively and very efficiently right out of my fast graphs. And I can, evaluate the stock and start looking at whether or not I think it's worthy of me spending my time. Now, I've concluded that Lowe's is. It's got a mid-range dividend yield, slightly higher than the market, over 2%, but it's really got tremendous dividend growth, and it's got consistent dividend growth. So that's what I really like about Lowe's. Now, going through the forecasting, going through the research, that's all part of the process. And that's really what I'm trying to highlight in this video today, is what the process, the methodology that I apply when I'm looking at these stocks. Now, the next one I want to talk about is Cisco Systems, one of the biggest tech stocks, obviously most prominent tech stocks. Notice how overvalued the market likes to put a premium valuation, but notice how by doing that, it created such a poor rate of return. Here's a company that actually did extremely well all through this period of time, coming out of the recession of 2001 into the recession of 2008 and 9, which did bring its price down. But the bottom line is, because the stock was so heavily overvalued, it really had nowhere to go for all those years. And it wasn't until the stock became fairly valued, even at today's undervaluation, that you started to get decent rates of return on Cisco. Now, again, notice that the stock market will misappraise these stocks. They will overvalue them and they will undervalue them. And once again, we have a dividend that was started in 2011, but has consistently grown ever since. You can see that last year, coming in November of last year, the stock was very overpriced. It is now corrected in this recent market correction we've had, and it's now become very attractive. It offers a 3.49, we'll call it 3.5% dividend yield that is growing, and it does provide the opportunity to give you some very attractive, future rates of return based on the fact that the market expects it to continue growing, and it could provide us a double-digit 15% rate of return at fair value. At the normal multiple, you even get a margin of safety. So somewhere between these two what-if scenarios, you probably have reality, in my opinion. And, now Cisco has become a mid-range. Now, here's one where 2.1% wasn't enough income. If you need current income, lows would be more for the investor who was looking for future growth of income and capital appreciation. Cisco currently I would recommend as a stock that has good current income, but also has the opportunity for capital appreciation. Now, once again, I will go through all the different metrics here, and I noticed some accounting convection going on in 2018. But, otherwise we have really good diluted earnings, which are GAAP earnings. Operating cash flow has been very, very strong and well covering the dividend. I go through free cash flow. It's also been very, very strong in covering the dividend. And very quickly, I'll go through these again. You can see the process I go through. And remember, I run different time frames when I run these metrics. I also want to recognize some other things here when I'm doing this, and that is some valuation references. And I look at sales, and the company does look attractive on a price to sales basis. Going back to operating earnings, I want to point out that the normal PE over this time frame has been over 18, but that's because we've had these high periods here where the PE ratios got high. But normally the PE ratio has been, relatively benign, if you will. It has not been that high, actually. So what I'm going to do here now is move on. Again, go into the adjusted operating earnings. I'm going to go through, these other factors. One place that I always go to, which I failed to mention, I'll go to the company's website. I will look for investor services and so on. That's, again, something that is easily facilitated through the FastGraph research tool. So, we can do that easily with the tool. And here I got a second company, another dividend growth stock with a moderately high yield that you can look at. And by the way, this is a AA rated company, very high quality, consistent earnings growth, a lot of price volatility, but a good dividend record since they've been paying one. So I like Cisco very much, and I actually am long Cisco already. And I think it's one that any of you who are looking to add a dividend growth stock with a moderate yield to your portfolio might want to take a look at. Last but not least, I'm going to take a look at Medical Properties Trust. This is a healthcare REIT, primarily hospitals. They, invest in hospitals. It's actually a very good REIT from the standpoint of, consistent growth over time. And you can see that now. If I shorten this time frame past the Great Recession, you can see that it's grown at about 6 to 8% each year. A lot of controversy on this stock. Wall Street Journal produced a couple of articles that were negative. I don't own this one yet, but I'm looking very closely at it because what I want you to notice is that the valuation has got very attractive, yielding 7.09%. That's one of the lowest valuations you have, seen it at from a standpoint of dividend yield. Looking at past dividend yields, a 7% dividend yield has always been a very attractive entry point into this REIT, even when it's as undervalued now. So if you're looking for current income and value, then I think this one really makes the cake. Now, there are two ways that you want to look at REITs. I don't look at earnings too much and so on because of a lot of dilution in the stocks. When I'm looking at REITs, I'm looking at either operating cash flow, which is actually funds from operations for a REIT, which then the tool automatically converts this to FFO, and that's what I'm looking at here. And then I also like to look at it from the standpoint of AFFO, or adjusted funds from operations, and I get a very similar perspective here. Now, what the difference here is, though, the AFFO isn't official as the FFO, which is why I like to also look at it, but it's calculated, it's AFFO, or adjusted funds from operations, minus FFO, plus rent increases, minus capital expenditures, and minus routine maintenance costs. So, it's kind of the bottom line, the free cash flow aspect of FFO, if you will. And I think what you're looking at here is the fact that the company, based on adjusted FFO, looks very, very cheap. Again, over a 7% yield. We've got very strong, potential going forward. So, this is a stock that I would consider for those who are looking for current income and the ability for that income to grow. But it also, because of the valuation, gives it a real opportunity to generate very high future rates of return. But I want to remind you, this is a BB plus company. It is not the quality of the other two I showed you, but this has a very specific place, I believe, in the investor's war chest, depending on what they're trying to accomplish with their money. Not everything I said is about rate of return. Anyway, this has been Chuck Carnevale. A lot of subscribers have asked for me to start showcasing some dividend growth stocks that I'm interested in. This will be the first in the series. There will be times when I will go through one company more comprehensively, but here I wanted to just give you an idea of the different types of dividend growth stocks you can look at. There are some that are good for more for growth, pushing total return as a combination of capital appreciation and dividend income. There are some that are in the middle, like Cisco. Lowe's was the one that met that bill, where you get some real good income plus capital appreciation potential plus dividend growth. And then finally, a good REIT like Medical Properties Trust, where you get very high yield, take a little more risk in a REIT like that of its quality, but it's actually proven itself over the years, as you can see when, by going back and looking at the graph. Anyway, this has been Chuck Carnevale. I hope you enjoyed this. It gives you some 3 stocks to research for your dividend growth portfolios, depending on your objectives. I hope you enjoyed it. If you did, ring the bell, give me a like, and also you might want to, subscribe to our channel, but also take a look at subscribing to Fast Graphs. We're continuing to make it better and better, and we got some exciting features coming up. But anyway, I really appreciate all of you, and I'll be talking to you again real soon. Thanks for watching.